China has just delivered a targeted strike against the paper side of the gold market, and the implications stretch far beyond any single trading session. Major Chinese banks have begun systematically closing ordinary investors out of paper gold products, instructing them to liquidate positions, shift into alternative instruments, or take physical delivery of the metal itself. This is not a sudden dump of bullion onto the open market, nor an attempt to crash prices overnight. It is a precise restriction on how gold exposure can be held inside the world's second largest economy, and it forms the latest chapter in a multi-year effort to reshape the way the metal's value is discovered. The largest commercial bank on the planet recently notified individual clients that gold contracts traded through its platforms would no longer be available after a set cutoff date. Customers faced three clear choices: sell outright, close existing positions, and move elsewhere, or demand the physical bars. Other major institutions followed in rapid succession. Within a span of roughly 4 months, a coordinated sequence unfolded across several of the biggest banking groups in the country. Each notice carried the same essential message: retail access to leverage paper claims on gold was being wound down. Official statements framed the moves as investor protection. That explanation contains a kernel of truth. Gold had risen sharply, touching levels well above previous highs before retreating more than 30% from its peak. Many retail participants who had entered near the top suffered heavy losses. Margin requirements were raised dramatically in response, in some cases climbing past 100% and higher. Authorities remember earlier episodes in which retail products linked to commodities inflicted widespread damage on ordinary account holders. Shielding the public from leverage speculation is therefore a genuine regulatory concern. Yet the scale and coordination of the current restrictions suggest a deeper structural purpose. The real objective appears to be control over the pricing mechanism itself. For years, the global gold price has been set predominantly in markets where paper claims vastly outnumber physical bars. When an investor purchases gold exposure through a bank app, a brokerage account, an exchange-traded fund, or a futures contract, no metal usually changes hands. The transaction records a claim on a ledger. The underlying vault may contain actual bars, but the number of claims written against those bars can multiply far beyond the physical inventory. Estimates of the ratio have ranged from several claims per ounce to much higher multiples in certain historical testimony. Because price formation responds to the volume of claims rather than the volume of metal, the result is phantom supply. Additional paper ounces enter the market without corresponding physical ounces, exerting persistent downward pressure on the quoted price. This arrangement has endured for decades in the major Western trading centers. Daily clearing volumes in London have reached tens of millions of ounces on paper, representing tens of billions of dollars in notional value, while only a tiny fraction of futures contracts in New York ever result in actual delivery. The paper market can therefore dominate. When physical demand occasionally threatens to overwhelm available metal, the exchanges retain emergency powers. Trading can be suspended, delivery conditions altered, settlement prices fixed, and additional performance bonds required. History offers a clear illustration. During a severe squeeze in another industrial metal years ago, an exchange canceled trades and erased billions in positions. Legal challenges reached the highest courts and failed. The paper system retained the authority to override physical pressure. The last time physical demand successfully forced a lasting repricing occurred in the late 1960s. Under the post-war monetary order, the dollar was formally convertible into gold at a fixed rate of $35 per ounce, and other currencies were pegged to the dollar. Persistent fiscal and monetary expansion gradually eroded confidence in that convertibility. Central banks and private holders began demanding metal rather than paper claims. A consortium of major central banks formed a coordinated pool to defend the official price by selling gold into any rally. On ordinary days, the London fixing handled a few tons. In the decisive week, hundreds of tons flowed out daily until more than 1,000 tons had left the pool. The market closed temporarily at government request. When it reopened, a two-tier system appeared. The official price remained frozen at the old level for central bank transactions, while the free market price immediately traded more than 20% higher. Within a few years, the formal link between the dollar and gold was severed entirely. The metal then rose more than 20-fold over the following decade as the market sought a new equilibrium. That episode demonstrated a simple principle. When a motivated minority insists on taking physical delivery, paper claims lose their ability to suppress the price. The system does not bend, it breaks. The current sequence of Chinese bank restrictions must be read against this historical backdrop. China is not attempting to dismantle another nation's pricing apparatus. Instead, it has spent more than 2 decades constructing an alternative architecture centered on physical settlement. The Shanghai Gold Exchange was established with a foundational rule that every contract remains eligible for physical delivery. Holders can call for the actual metal. That convertibility imposes discipline. It becomes impractical to issue 10 claims against a single bar if any of those claims can walk into the vault and demand the bar. As a result, the Shang price remains anchored more closely to physical reality. When the Shanghai, quote, diverges from London or New York, arbitrageurs step in. They buy in the cheaper venue and sell in the more expensive one, transferring metal and gradually pulling the paper markets toward the physical benchmark. Offshore contracts launched in Hong Kong and linked to the Shanghai pricing mechanism further extend this channel. International capital can now obtain exposure settled in physical metal held in Chinese-controlled vaults without needing a domestic Chinese bank account. The infrastructure for a physically anchored global price is therefore already operating. Physical demand has already demonstrated its capacity to strain the Western system. Temporary tariff concerns in late 2024 prompted rapid relocation of nearly 800 tons from London to New York within a few months. Withdrawal queues at the Bank of England stretched from 1 week to 8 weeks. Lease rates, normally a fraction of 1%, surged above 10%. The deepest gold market on earth struggled to source metal that was supposed to be readily available. That episode involved only a fraction of outstanding claims. Central banks, meanwhile, have been converting reserves at a steady pace exceeding 1,000 tons annually for several consecutive years. The catalyst was the freezing of a major country's foreign exchange reserves in early 2022. Every monetary authority absorbed the same lesson on the same day. A claim that can be immobilized by another government is not a true reserve. Gold held in one's own vaults cannot be frozen in the same manner. Consequently, the share of gold in global central bank reserves has risen while the share of traditional sovereign debt has declined. For the first time in the modern era, official gold holdings exceed official holdings of the principal reserve currency debt on a market value basis. The institutions managing these balance sheets have allowed the revaluation to stand rather than rebalance back toward paper assets. The shift is not a short-term trade. It is a structural transfer from promises to property. Vault construction provides further evidence of expected future demand. Facilities in Hong Kong are being expanded toward capacities measured in thousands of tons over the next several years. Paper claims require no such storage. Physical metal does. The infrastructure is being built for the volume of metal expected to move, not for the volume of ledger entries. The restrictions now being imposed by Chinese banks close the remaining paper outlets inside the domestic system. Retail investors seeking gold exposure must increasingly acquire the physical metal. Even a modest increase in the percentage of claims that convert into delivery can tighten the physical market and accelerate the convergence of paper prices toward physical reality. The question then becomes what gold is worth once metal rather than claims sets the marginal price. A more revealing question is what other assets are worth when measured against gold rather than against the unit of account that has expanded so rapidly. Consider residential property. In the mid-1970s, the average American home cost roughly $48,000, or several hundred ounces of gold at the then prevailing price. Today, the same average home costs more than 10 times as many dollars, yet fewer than half as many ounces of gold. Automobiles tell a parallel story. The average new car once required more than 40 ounces of gold. Today it requires roughly a dozen. A gallon of gasoline once equated to a small fraction of an ounce. An ounce now purchases several times as many gallons. Measured in the expanding currency unit, everything appears to have become more expensive. Measured in the metal that cannot be expanded at will, the same goods have become markedly cheaper. Productivity gains should make goods more affordable over time. When that outcome is invisible in nominal prices, the measuring unit itself has been altered. Similar dynamics have appeared in silver. Shanghai prices have traded at substantial premiums to Western paper benchmarks, and physical dealers have quoted spreads of several dollars per ounce above the electronic spot price. When physical demand asserts itself, the paper quote loses authority. Several indicators will reveal whether the current phase of the transition is accelerating. The size of the Shanghai premium over London remains the primary signal of physical pull. Lease rates and withdrawal delays at the principal Western vaults measure the degree of strain. Quarterly central bank purchase data track the ongoing conversion of paper reserves into metal. Vault capacity expansion in Asia signals expected future physical volumes. Further restrictions on paper products inside China complete the consolidation of the domestic system around physical settlement. When these measures move in the same direction simultaneously, the pace of repricing becomes visible in real time. Every financial asset ultimately belongs to one of two categories. The first consists of promises, claims that someone else will deliver value at a future date. Unallocated accounts, futures contracts, exchange-traded fund shares, and sovereign bonds all fall into this column. The second consists of property, assets that are no one's liability. Physical metal belongs here. The coordinated actions of major banks and central banks since early 2022 represent a large-scale migration from the promise column into the property column. The most sophisticated balance sheets on the planet are executing the same trade. Physical gold settlement keeps markets honest, yet the practical difficulties of large-scale delivery, storage, insurance, and security limit the number of participants who will insist on taking metal. Digital forms of scarce property that can settle in minutes, verify themselves, and require no specialized vault infrastructure offer a parallel path for those who wish to hold assets outside the paper system. The nations are conducting the transfer primarily through gold. Individuals can position themselves with instruments that achieve the same finality of ownership more efficiently. The sequence now unfolding is not a one-day event and will not produce an instantaneous jump to a new equilibrium. It is the latest and most visible step in a process that began when physical settlement rules were embedded in an Asian exchange more than 20 years ago, accelerated when reserve managers learned that paper claims could be immobilized, and is now being reinforced by the systematic closure of retail paper channels inside the largest gold-consuming economy. Price discovery is migrating slowly but measurably from ledgers back toward vaults. The metal that has served as money for thousands of years is once again asserting its capacity to set its own terms.